Have you seen the oil price today? It's crazy low. We gotta buy it right now, and then eventually, when the price goes higher, we're gonna sell and we're gonna get rich. Have you heard or thought something similar in these days? Well, if you had, no problem. It's absolutely common, but unfortunately it's wrong. And the reason it's because we often mistake equity and commodity. So today we're gonna understand the difference between these two types of investment with the help of LeBron James from the Los Angeles Lakers and Derrick Rose from the Detroit Pistons. Tonight, Lakers are playing Detroit, and you want to bet on the game. You have two bets that you can do. One, we're gonna call it the equity bet, and the other one is the commodity bet. To win the equity bet, you need to guess the final trend of the game. In other words, you need to know who will win. To win the commodity bet, instead, you need to get right the exact final result. For example, Lakers up by more than 20 points. Let's see an example of equity investment. Here is the stock price for Exxon. You can buy shares of the company, keep those shares as long as you want, and if the price raises, you can sell them and make a profit. This is called investing in equity or stocks. And to make a profit, you just need to guess the trend of the market. Many people think that you can do the same thing with oil. You buy, you hold it, and eventually you sell it. But unfortunately, you cannot. And that's because oil, it's a commodity, it's not a company. And what you can do with commodity, you can place an order for that commodity, which are called futures, and you can try to sell that order to someone else for a higher price. Let's see an example. Meet again Wolf, the speculator, and Chuck, the producer. Today's price for oil is $15 a barrel. Wolf calls Chuck. Hey Chuck, if I order 1,000 barrels for October, how much do you want? Chuck believes that in October demand will grow, and by then oil will cost $30 a barrel. And so he goes, I want $30 a barrel, Wolf. Wolf thinks that oil's demand in October will be even higher, and those barrels will worth $40 each. Deal, Chuck. Send me 100 barrels for October. I'm paying you right now. He sends the money and gets the contract. Wolf has now time until October to sell those barrels for more than $30 each if he wants to make a profit. As you have seen, today's price for oil, which is $15 a barrel, is not even taken into consideration when we're talking about futures. Indeed, Wolf didn't pay $15 for each barrel, but $30. That's because in the commodity market, you don't just need to know the trend, like oil price is going up, but you need to know how much it will go up, like oil price will go more than $30 a barrel. So you understand that since nobody, at least nobody that I know, can see the future, this is a very risky and dangerous game to play. But let's wrap up everything in a few seconds. Investing in commodities like oil is very much different than investing in equity, like buying shares of a company. If the market was a basketball game, investing in equity would be like betting on the final result of a game. It's easier, but you make less money. Investing in commodity instead is like betting the exact final result of a game. Way more difficult, but of course more lucrative. Molto bene. In these 3 videos we have just seen why oil price can go negative, and then we've seen what are futures and how they work, and finally we've seen the difference between investing in commodity like oil, which is more risky, and investing in equity like buying shares of a company. I hope that you enjoyed this video. If you did, please like, share and subscribe to my YouTube channel, Tales of Startup. I'll see you in the next one, and as always, fai a MODINO.